The argument for a double-dip recession is looking to diminish with the fact that global stimulus spending has been containing the credit crisis since the beginning of 2009. However, the slowing growth in developed economies is still a major concern for global investors. Where are the potential areas of investment for investors? We have Mr. Liang Shibing, investment analyst from PhillipCapital, to tell us more. So, Shibing, tell us first, what is your outlook on the US equities?
Since the middle of this year, the US S&P 500 has been trading in a range between 1130 and 1020. A few weeks ago, actually, we saw the index fell towards the lower end of the summer trading range, but it quickly rebounded. Now it is close to the top of the summer trading range, so in our opinion, until we see a significant breakaway from the current trading range, we are still doubtful whether the rally will be sustainable. The reason being, momentum has turned lower since the April high that marked the exhaustion point for global stimulus. Even with further stimulus or government intervention, the impact will be less than successful as the first.
How would you describe the current market sentiments?
By looking at a few sentiment indicators, investors are pretty bullish on the short-term outlook on equities right now. The AAII bull ratio is currently slightly above 58%, with 44% forecasting the market to rise and 32% believing it will fall. This level of overall bullishness is the highest since late April this year. Having said that, many other sentiment indicators is actually signaling an above average sense of optimism within the retail market participants. But retail investors have a very short attention span and will turn the other side of the boat the next split second. What is more important is the global equity fund outflow in just the first week of September, which is equivalent to the whole month of June. And we are talking about an $8 billion US dollar withdrawal. We would prefer to see this as the start of an intensification of selling.
What investment approach would you advocate for investors then?
Investors should take a long-term view and ignore the short-term market volatility at the moment. This is especially crucial given that there's a lot of mixed macroeconomic news which is causing the high level of volatility we are seeing in the daily market movements. The truth is that no one can consistently foresee the market direction, and investors should not try to time the market in any way.
Where investors should be investing then?
The Asia Pacific ex-Japan equities are doing pretty well at the moment. Take China as a good example. Its latest industrial production rose 13.9% in August from a year earlier, showing that the Chinese economy is maintaining momentum even as the government clamps down on property speculation and limits lending. The growth story in China is not dead yet, and this is going to drive Asian economies moving forward. We believe that Asian equities unit trusts will outperform for the rest of the year.
Thank you, Shibing. That's all we have for you today. Tune in next week for more market updates.